Can you hear me now? Yep. Fine. Good. Okay, so welcome everyone. I hope we're all here for money, banking and financial markets. I'd like to say a few things before we start the lectures, just to clarify what this course is about and whether you should be here, whether you want to stay here, what the exam's going to be like and everything. So let's be very clear up front what this course is about. Unlike other courses I've designed in the past, like Macro 3 and Macro 2, because I'm a macroeconomist really, this is not meant to be a technical course. I mean, there's a lot of maths involved. However, you do need to have the prerequisites. Now, I've put in red on Blackboard some prerequisites, which if you don't have, you must either leave the course or come talk to me or go to the undergraduate office and pick another course. Why? Because in 2 weeks from now, I mean, the undergraduate office is very busy now, but in 2 weeks from now, we'll be doing checkups that everyone's got the prerequisites for this course. And it's happened in the past that we ask some students to leave because they didn't have the prerequisites. Somehow they got enrolled in this course, and then they get really upset that when you tell them 2 weeks later, you're not supposed to be here. And I sympathize with that. I mean, there's, but I'm quite clear right from the beginning, check on the Blackboard the prerequisites you should have. You should have advanced maths, advanced stats, and you should have the macro that you've done in the second year, which is first and second semester. It's as clear as that. Yep. Now, some of you may have come from different backgrounds. Again, somebody will have checked, but we'll check again. The reason why I'm saying this is that although the course is not technical, I will expect you to have a very good knowledge of macro. The course is not a corporate finance course, right? So we're looking at the interaction of monetary policy and the financial markets. In other words, how central banks can influence the financial markets. Therefore, unless if you understand your macro at a very good level, you understand what we're talking about, right? So that's that. So the course will be mainly, instead of sort of dealing with mathematical models that I've done in the past a lot, the course is mainly focused on practical aspects, and every now and then we'll be using some things you should know from macro, or you will understand better from macro, from your macro knowledge. But the course will be linking everything to economic theory. So although I'll be looking at financial markets and how monetary policy, central banks can affect the financial markets, we'll always be linking everything. I mean, this is a university after all, right? To macro and economic theory. Right, so I hope you'll find this course enjoyable. I mean, in the past, students have really liked this course, so I hope you'll enjoy it as well. I repeat, this is not a corporate finance course, so if that's what you had in mind, maybe I can clarify this. No, this is not. We won't be looking at corporate finance, and I will assume that you have very little or no knowledge of the financial markets, and you will see that from this first lecture, which is going to be a bit boring to those who are a little bit familiar with the financial markets. From then on, we're going to move away really fast, and we're going to go into more interesting things. But I need to cover some definitions and some basic stuff. So this sort of first lecture will be a little bit boring to those who are quite familiar with financial markets. So what else? Let me just say a few more things. You may want you may be wondering rather, oh, if it's not a very mathematical course, why do you need advanced maths and stats and macro? As I said, macro you do definitely need, because everything we'll be doing is based on how the macroeconomy works and how monetary policy affects macro. The stats and the maths will be because one or two topics do cover quite a lot of stats and maths, that's all. And the 25% assignment that you'll have, it's a mathematical, half of it is at least, it's a mathematical problem that you will need some basic derivations, statistics, and macro. Okay? If we're clear with that, and of course, there won't be help there. This is the only independent piece of work that you will be submitting to this course. So there will not be collaboration or help. And again, I want to be very, very clear. I'm sure you're here because you like that sort of thing, you know, how financial markets interact with monetary policy. If you pick that as an easy course, that won't be the case. Okay? Why? Because I will tell you something about the structure of the exam, how strict with plagiarism or copying from the internet, and if collaboration is detected, as it was in 2 cases last year, you're going to get 0 and you may be disqualified completely. And we do have means of doing that. And again, don't get me wrong, I don't want to say welcome and listen to this. I know you're not going to be doing this, but if I didn't explain this, later on you will say to me, why are you so strict with these regulations? Because we are. So let's be upfront, very clear with all that. There will be no tolerance with plagiarism, copying from the internet, and I'll come to that in a minute as well. So, again, for those who came late, check your prerequisites. Office hours, like most of the courses nowadays, we don't have such a thing as an office hour. I mean, we're trying to resolve things on Piazza, right? So any queries you have, you upload them on Piazza, and your students will help you, your fellow classmates will help you, and if they don't, I will. That's the way to do it, right? Of course, some of you may have something more personal to talk about that you don't want to talk on it, on Piazza. In that case, you email me and we'll make an appointment. It's as simple as that, yeah? And I will respond pretty fast if it's something more personal. And by personal, I don't mean, I don't understand this question, can you help me with it? I mean something that really affects your academic performance, or something you want to talk to me about the course. Yep. Now, so do enroll on Piazza immediately. Let me just say something about the classes and the tutorials. Exercise classes, I mean, obviously you will have been allocated to classes, right? And they start from next week. Unfortunately, they start from next week because some of the questions will not have been covered, but I start with very simple questions in the first tutorial. I will try to run all classes, to be fair, and I will try to mark all essays and exams as a first marker, just to be fair, because I think that's more fair, right? Now, classes, initially, it will be a mixture of what looks like multiple choice questions, but it will not be. Like, for example, the classes may be, here's a question, what do you think is right, A, B, C, or D? You can raise your hand, right? And you can say, yeah, we believe it's B. But then I'll be asking why. And the same will be in the exam. Okay? The exact same format will be in the exam. If you answer the letter right, you will get about 3 marks. Right? in the exam. But if you answer below your A, why you think it's A or B or C, you will get another 10 marks. So obviously you can't afford to gamble, to say, oh, I'll go for A or B. I have nothing to lose. Yeah, I mean, there's always 1 in 4 to get it right. But still, you're going to be missing the other 10 marks because from the way you'll be writing, I will know that you don't know the answer. So I'm trying to do it this. One, because sometimes multiple choice questions clarify things better. You may know the answer, but when you see 4 similar things, it's much clearer whether you really know the answer. And then the way you explain things, that will give me the opportunity to give you more marks. I hope this is clear. The same will be in the exam, and I'll come to this in a minute. So you don't have to submit your answers, but you have to know the answers because we'll discuss them in classes. And talking about the exam, we said that the way that you're going to be assessed is going to be on 2 pieces of work. The first will be the assigned piece of work, which you will submit on the 19th of March. It's on the web, on Blackboard. By the way, perhaps here I should say that everything you need to know is in your course outline. Absolutely everything. So when you put some questions on Piazza, I'm not going to reply to questions that they're already in the course outline. Yep. I have this reputation that I spend a lot of time on my course outline, so you're given all the information you need. So download the course outline, have a look at it, and you know, if something is not there, upload a question on Piazza, and I'll try to get back to you. But the idea is this, that you will have a deadline, 19th of March, I think it is, check it, to submit a written piece of work, which you will receive approximately 2 weeks later, hopefully. And that will count for 25% of your final mark. The remaining 75% will be done in the final May or June exam. And the structure of the exam is going to be 2 parts. Part A is going to be exactly what I've just talked about, what looks like multiple choice questions, but each one of these will give you, so there'll be 4 of them in part A. It's compulsory to do the whole part, and you'll be given 12 or 13 marks for each one of these 4 questions. In total, you get 50% from part A and 50% from part B. So, yeah. So part A is going to be 4 questions, and again, if you get the letter right, as I said, you will get your 3 marks, or 2 marks, whatever it is. Usually it's 3 marks I give. But it says it clearly on the exam paper, what you'll receive. If you do not answer correctly underneath what you asked, you will lose these 10 marks. Is that clear? And of course, sometimes students ask me, okay, say that I got the answer wrong. So it was B and I put C down. But what I describe below to what you ask is correct. Will I receive any marks? Of course you will. Yeah? And you can receive more than 3 marks for that. Of course you're going to lose definitely the 3 marks. That's clear, right? So you will never get full marks for that question. But if you answer the question correctly, you will receive still marks, even if you've lost the 3 marks because you got the letter wrong. Clear? So that's part A, and then part B is going to be more like an essay type. It may have sub-questions. And again, together that you will get 100%. That 100% will give you the 75% in total, plus the 25% you'll have from the assignment for March. And that's it, really. Now, be very careful here. because sometimes you may misunderstand what the exam is about. You don't have a 24-hour window for the exam, right? This exam is online. Well, this is what I've requested, that it goes online, but then you have a synchronous time to finish the exam. So all students will be starting, let's say, 9 o'clock, finishing at 11:30. Yeah? The actual exam, before I went online, was 1.5 hours. Now, I've asked the university to give you 2.5 hours, just to upload some graphs if you want, some technical issues. Sometimes, well, initially I asked the university to give you 3 hours, so they may give you 3 hours, but I know they will give you at least 2.5 hours, maximum 3 hours. But don't tell me you promised 3 hours. I repeat, I've asked for 3 hours. I know last year was 2.5 hours. So they give, because they thought I'm giving you too much time there for an exam that the structure didn't change, but it was 1.5 hours on campus. Why are you giving them double that? So, fine. So it's timed. You understand what timed and synchronous means, yeah? It will start at a specific time, and the system will close at a specific time. If you decide to leave the country, if you decide to forget about the exam, you've missed the exam. There's not going to be a 24-hour window or anything like that. Yep. So that's how it's going to be. And the questions will not be questions that you can find easily on the web. Okay, I mean, the questions are in such a way that they benefit the students who've worked. So the reason why I'm saying this is that if you copy things from the web, we will know straight away, because we've got artificial intelligence as well to find out who does what. So since we moved online, and students like online, because some people get stressed, I mean, my daughters are the same. Some people get stressed, you know, on campus, and they prefer to do it with a cup of tea. I'm ready, let's start the exam, I'll do it at home. But that doesn't mean that gives you a free ticket to open the web and start copying things. You're cheating yourself by doing this. So I hope I'm clear. If you think this is going to be an easy course, you're wrong. I mean, last year 2 people were disqualified because there were things copied from the internet. Another thing that came up in the staff meeting, and I think I should let you know about these things. Last Wednesday we had a staff meeting, is some students think they become heroes when they go on Course Hero or something like that and copy my material, somebody else's material, and put it on there. That's illegal. And from this year, the university promised to track down the students, and you may be disqualified completely. I know you wouldn't be doing this. Usually it's 1 or 2 students who think they become heroes by doing this. And then the Course Hero, what they do is they charge you to join them, and they get all the work that you do for them by stealing our work, and they charge you on top of this. So, you know, when we try, but now there's a legal team that's going to be chasing all of these different sites and track down who's given what. I'm just saying this because it came up in the last meeting we had on Wednesday. What else? Let me just see. Let me see if I can remember if I have anything else, and then we can. Okay, so we talked about the exam format. We talked about, I didn't say anything about, by the way, the structure of the exam will be, I'll give you a mock exam paper on the website, on Blackboard. So you know exactly the format of the exam, just in case you forgot what I said here. Textbooks, I mean, somebody already emailed me that they can't get hold of the Cecchetti and Schoenholz book. Never mind. I mean, it's in the library. They may be not online. It's in the library now. There's a few copies of it. But the main textbook that we'll be using is Mishkin, right? And I may have split the reading into main and additional. So you see where it says, well, I don't know did I phrase it basic or main reading? So main reading is the basic things that you have to read. From then on, of course, papers and further references will enrich the answers you'll be giving, and I strongly recommend you not to stay on just the main. But yeah, and I don't always go by the book, right? I mean, I know that some lecturers will just copy the book, will give it to you there. I don't do that. I use my own resources. I use my own sort of interpretations of things, and therefore some things will be definitely very close to the book, some other things will not be, but I've given you references where to find everything. So I think that's about it, really. I talked about main and further reading. Is there something I've left perhaps you want to ask before I start?
When's the midterm available to us to like start working on? Is that just that week, or do we have it beforehand?
It will be within the next 2 weeks. It will be on the system. It will show. And if it doesn't, send me an email or just mention I mean, I plan to put it up in a couple of weeks. Yep. Anything else? Right. So let's start with some boring stuff, because most of you will know this. And I want to start from a boring question. Which is, do we need financial markets? I mean, that is really a silly question, right? It's not even an O-level question, you know, a GCSE question. The reason why I put it up there is that because of following the financial crisis of 2007, 2008, there was a lot of debate whether we do need banks. I mean, after all, what they do is they make profit. Banks are there to make profit, right? But if something goes wrong, we pick up the bill. And that is a fact. When we say the government picks up the bill, that's rubbish. I mean, we pick up the bill because we're the taxpayers, right? So many people were asking this question, do we need banks? Can we not do without banks? Can we just bypass the banking system and actually deal directly with the central bank? The problem with the central bank is that it's supposed to be somewhere away from the center of the private sector, so it has the authority. Because if you start dealing with the private sector like a commercial bank or like a shop, then you start losing credibility. But let me just say this, that financial markets deal directly with the private sector. And because they deal every day with the different parts of the private sector, they have the ability they have a collective way, if you want, of raising funds from investors. And then what they do is they channel these funds to corporations, firms, the household. And this is how economic growth picks up, right? Somebody who doesn't have will make a loan. Somebody else who has more will save and pass it on to the bank. The bank will take it and make it a loan. The shop, the enterprises, the firms will be able to use that loan to expand their businesses, and that really enhances economic growth. So without financial markets, borrowers would have difficulty finding funds or finding lenders to expand their businesses. Households would find it really difficult to make a massive loan to buy a house, mortgage. And some of you perhaps will find it difficult to be here if you rely, like most of you, on a student loan. So you might say, yeah, but that was a government scheme. Yes, but if you look how it's funded through the private sector, again. And it's banks who have agreed to give that interest rate. So the answer to this is, yes, we do need the financial system. We need banks. We need the banking system. We need the financial markets. But the second question that one should ask is, have financial markets been adequately regulated? Well, I mean, it's not just my personal opinion. The answer to this is no, right? Particularly from 2000, with Greenspan policies that he didn't believe in interventions, and the financial liberalization that follows since 1999, 2000, where capital was moved very fast from one bank to another. Banks started getting involved with more risk rather than just deposits. They started getting really involved with high risk investments. And the fact that there was no capital controls or anything, not that it's a good thing, it's a good thing not to have, that meant that there was a lot of risky lending, too much borrowing, and these markets were not adequately regulated. Okay, I mean, the US, as I said, under Greenspan, it was a well-known fact among economists that he was turning a blind eye to intervention and regulation. The result was we ended up with a massive scale financial crisis, as we experienced in 2007, 2008. It started like a subprime crisis with the housing industry, and then it moved on to a Eurozone crisis, etc. We'll talk about these things later. So the answer is no, it was not adequately regulated. Probably you wouldn't remember this, but your parents would. There was an era in the 90s where, you know, everyone in the city was boasting that they're yuppies. Have you heard the term yuppies? Yuppies are the people who came from nowhere, some of them not even a degree, and all of a sudden found themselves dealing and trading in the city, making loads of money, taking a lot of risk. And they were not held accountable at the end of the day. So there was a lot of that. There was a lot of agents and companies that were misbehaving. And the fact that all of a sudden some massive bonuses were offered to CEOs in companies that were linked to trade performance, you can see why they had the incentive to take massive risks. And at the same time, they were not held accountable if something went wrong, up to that crisis. So what happened since? Are we now regulating the financial markets adequately? Well, again, it's not my personal view, but the answer is still no, but we've moved a little bit further with that. Let me just make clear this. Too much financial regulation will destroy many things and will slow down economic growth. I hope you understand that. Because it's the opposite of what I was saying earlier, that you let banks take some risks, make some loans, let industries and firms speed up their process. They have an asset there, they have some capital they borrowed, they can expand their businesses. If you regulate everything, okay, if you regulate everything, you would slow down economic growth. So it was really fine-tuning what is the right amount of intervention. But following the massive 2008 financial crisis, we've had in 2010 the Basel III Convention that comes in and says, you know what, more capital, more bank capital that is, must be held by banks. In other words, let the shareholders of banks, those who hold bank capital, fund more. In other words, if it was 7 to 8% previously, now it's 12 to 13% has to be held by bank capital holders. So they take more risk. So you may say, okay, from 8% or 9%, they went to 12, 13. Does that make much difference? No, it passes a little bit more risk to bank capital holders, but at the same time there was a number of other things introduced. For example, there was global financial regulation interacting with monetary authorities at the national level, central banks in other words, to come up with a recipe that can protect the consumer. So, a number of institutions introduced across the UK, for example, the FSA, which up to 2013, it was the FSA. I mean, the FSA was given more powers, and it was given more authority to regulate the banking system. But later became the Financial Conduct Authority, okay? And its main purpose was really to protect the consumers. In other words, do they get a fair deal? If you put your money in a bank as deposits because you don't want to take risk, and the bank takes it and starts investing on very risky assets, are you covered? I mean, you didn't want to take that risk. How come they take your safe deposits and they invest in risky assets and they say, sorry, we've gone bust. You're not going to get your money back. Well, I mean, you could have taken the risk yourself, right? But you thought your money was safe. And this is what happens with the Financial Conduct Authority now. They say, for example, that up to £80,000, if you have in the bank, that's safe. The government will step in and give you the money back. Obviously, if you want to keep 2 or 3 or 400,000 pounds in the bank, obviously you've got a lot of money to put on the deposit, but they won't cover that. But up to £80,000, they protect the consumer. And similar things, €100, for example, €100,000, not €100, will be for the European Central Bank, etc. So you get the idea here that there's a number of things that were introduced that were actually there to protect the consumer. Right, so the next thing I want to do, if I can log into this, is, I mean, we will talk more about financial regulation later in the course when we come to discuss the financial crisis. But another silly question that I want to cover is, when you say financial markets, what exactly do you mean? I've had this question so many times in the past that I thought it's only fair to explain. So, what do we mean? Well, do you mean the stock exchange, they asked me. Yeah, I mean, partly the stock exchange, partly, but not just. I mean, there's capital markets, which deal mainly with stock, as you understand it, shares and all that, or bonds. There's the money market, which deals mainly with mutual funds and short-term financing. There's the commodity market, and you can read more about these things. that usually facilitates the trading of commodities. But of course, you can make money on these things, right? I mean, commodities, when I say commodities, it doesn't really refer to just soft commodities like wheat and barley or whatever. It could be many things like hard commodities. Like, for example, tell me some hard commodities. Anyone? Mining, gold, cement, silver, whatever. So, you know, these are the markets that facilitate the trading in commodity. Then there's the derivatives markets. I mean, the derivatives are very interesting because, I mean, we won't be covering derivatives really from the point of view that I'm dealing with monetary policy, and this is corporate finance. But of course, we'll be coming back to derivatives because it is relevant. I mean, part of the financial crisis was around the derivatives, which ironically, the derivatives are there to hedge, to insure, if you want, against risk. Yet these are the markets that take the highest risk. And most of the crisis actually came from the derivatives markets, the hedging. So think of this, that you and I come to some sort of agreement that you come to me and you say, you know, I'm in insurance. So you come to me and you say, look, I've got some financial assets that I'm not sure whether they're heading up or down, and I want to insure them against risk. So we agree on a price. Yep, we agree on a price, and I'll say, okay, on that particular day, I will give you this price for these assets. But these assets refer to a third party. Does that make sense? So the underlying risk is not between me and you, is that you come with a third party asset and you say, I want to insure this from that company. So all the underlying risk is with that company, but we make a deal of the price of that piece of paper that you hold, that, you know, I can hedge against that risk. Yes, all sorts of interesting things that happen in financial markets. So that's the derivatives market, and we'll come back to this, there to manage financial risk and to take a lot. Then there's the future markets, and I hope you understand what this is. This is all about, again, making a deal in the future. If for any reason you want to make, to sort of agree on a price of something, let's say trading, right? You work in China, let's say. You want to export to Europe. You're not in the same currency. You don't know what's happening, either in China or in Europe. These commercial companies will come and make a deal in the future markets that let's say that these products will be sold at this price in that future date. So we know exactly how to go about this. Now, if something happens, either because of the exchange rate or the price, the deal is still on, right? So these are the future markets. The foreign exchange markets, you understand, it has to do with currency risk and exchanging currencies, but not just. There's a lot of investment there as well. And then you've got the insurance markets that facilitate the redistribution of various risks. And they can cover from houses, cars, to industrial estates, shipping cargo, or even your hands or fingers if you're a musician. So these are, again, the insurance markets. So these are some of what we refer to as the financial markets. It covers all of those things. And there's many different types of markets and they deal with many different types of assets. So the next boring question I'll cover, as I said, because I promised not to assume that you know much, is what is an asset? Okay, we've covered what is a financial market, what do they do, which are the markets, what is a financial asset? Well, basically, in plain English, anything which can be converted into cash is called an asset, right? Is this an asset? Yeah, I can sell it. I can get some money for it. This is an asset. But financial assets as well can be converted for cash at some point, right? So anything that can be converted into cash, I can call it an asset. But as far as we are concerned, I want to split assets into two, safer and riskier assets. Safer assets would include cash. By the way, nothing is safe, right? You can have cash and get mugs in the streets, and they say, you call that safe, you know? Or you hold it and there's inflation completely destroying the value of that. But we're saying safer, right? And riskier. So safer assets could be cash, certificate deposits in the States, or basically saving deposits, which are of a fixed maturity. So some of you may have some fixed maturity deposits, right? Or certificate deposits. Current and savings accounts, treasury bills, government bonds, fixed income securities, which are called fixed income because they will offer you a fixed income every month, right? These are safer assets. And then we move to riskier assets, equities, shares, commodities, real estate. Somebody asked me, but is real estate risky? I thought investing in houses is the safest investment you could do. Yeah, it is. Many believe that investing in houses, it's a safe investment. But then again, many have been in negative equity, right? During financial crisis, in other words, the house worth less than the money they borrowed from the bank. And it's a well-known example. I mean, there's thousands of cases in different countries where you may end up with negative equity because basically you bought more than the value of the house currently. But there's other reasons why an area can get worse. I mean, when you bought a house, you thought the area is safe and nice, then something happens, it changes, the value of that area goes down again. There's many reasons why real estate is not as safe as we think. Currencies, corporate debt, commercial paper, derivatives, etc. Now, the good news is we'll be dealing with, which one do you think? Safer assets. And why we're going to be dealing with safer assets? Because it's safer for me to do so? No. It's because this is what central banks use. When the central banks want to influence the financial markets, they only have 2 or 3 things they can do. And one of them is money, print money. The other one is issue bonds. In fact, what we'll say during this course is that you can't do one without the other. You can't just increase the money supply without backing it with government bonds, right? So this is what we'll be doing. We'll be looking at safer assets mainly. Of course, at every point we'll be coming back to discuss risky assets, but this is not the focus of this paper. So what I'll be saying is that every time the central bank wants to affect the financial markets, they will issue bonds, they will change the interest rate, or they will print money. These are their tools. Actually, these are not their tools, but these are, we'll come back to the tools, but this is what the method, the main methods they use. So, the second question then, the third question you may want to ask is, okay, and how are they going to do this? How are they going to influence the financial markets? Well, there's something which is called, is there a clock in here somewhere? I mean, I've never taught in this theatre, although I'm sure I've covered all the theatres in this university. There's no clock, right? Oh, excellent. That's very useful. Okay. Fine, okay. So, so basically, I don't want to make sure that, that you get your break done. Right, okay, so basically what we'll say now is that the easiest way to understand how central banks can affect the financial markets is because they rely on the interdependence of assets. What do I mean by that? Let's say that banks can only influence bonds and money, right? I mean, broadly defined, guys, this is the case. Banks can influence the financial markets through bonds and money. You may say, but they changed the interest rate. And what we'll say in this course, and you've done it if you've done macro, the price of money is what? Is the interest rate. So whether you change the interest rate or you change the money, it's like me talking, do I change the quantity or the price of a good? It's the same thing. If you restrict the quantity, the price will go up. And yes, the central bank is the monopoly of money. Anything else is counterfeit, guys, right? Don't want to hear about cryptocurrencies here. So what we'll say is that broadly defined, they've got bonds and money, okay? And let's say, therefore, that an individual, this is the average household out there, the rational agent, as we call them, holds both money and bonds. So therefore, the wealth of the economy is just bonds and money. So you look at the financial markets, there's only bonds and money. Fine, therefore, am I right that I can, if I add up all the bonds that were issued, the bunny, right, in one product, if I add up all the bonds that were supplied and all the money that were printed, that were supplied, then that must be covered for equilibrium by the demand for money and the demand for bonds, correct? Otherwise, I'm not in equilibrium. That means that some of the bonds I issued have not been sold. But that never happens. Their price will go down until you sell them. So that is the case for equilibrium. Therefore, if this is in equilibrium condition, it's equal. I can take bonds on one side, I can take money on the other side, which tells me what? That any excess supply of bonds, can you see that? If the supply of bonds is not the same as the demand for bonds, let's say that this is a positive number here, in other words, there's more supply of bonds than demand for bonds, this is going to create an excess demand for money. Because the bonds will not have a lot of demand, they'll be going to the money markets. And this is what happens, you know, in reality, right? I mean, in reality, this is what happens. We see investors move from shares into bonds. When they want something liquid, like during the financial, they were moving to very short-term liquid assets. Liquidity had a very high demand. So this is exactly what happened. An excess supply of bonds will be met by an excess demand for money, and we're back in equilibrium. So this is what the central bank relies on. If one market is in equilibrium, the other one must be too. Interdependence of the financial markets means that I can change interest rates if I want, the price of money. And the price of money works very much in an interdependent way. So for example, if I print some money, this money will go around, we'll say in later lectures, and we'll see how the banking system makes money out of the printed money. Or, if I change the policy rate, which is the base rate in the UK, there will be a domino effect on all longer term rates, another private and state rates, okay? So this is what they rely on, that by influencing the base, the monetary base, the money they print, or the interest rates, there will be a domino effect in all the financial markets. They change the policy rate, that will have a domino effect in the high street banks, and that will affect their rates. Does it always happen? We'll say no, and we'll see why. But overall, that's the case. So, but of course, what happened since the 90s basically, with the massive financial liberalization, particularly in the Western sort of countries, what you'll find is that this domino effect doesn't affect just a country. If something happens in one country, there's a domino effect that affects all countries that deal with that country. And because financial markets have become very much global, you will see there's a contagion, right? There's a contagion, which of course leads to financial crisis of a global scale. And this is why we've had more and more global financial markets crisis lately than we had in the past, in the 60s and the 50s. Because the financial markets have developed really fast. And you can buy now. I mean, I can be sitting here. One of you could be on some app now investing money. I hope you listen to the lecture, but I'm just saying, and you can be investing on Japanese cars, right? Or on some mutual fund. Yeah, careful with your money. So, this is it. This is it. So what we're going to do next now is we're going to have a short break, 5 minutes, right? And then we're going to go into the bond market. Okay? Is that okay? So I'm going to take the two financial markets, bonds and money, and I'm going to start working with bonds and then money.
First, I don't have a background in financial markets, so I'll ask the same questions. When you talk about the interdependence and the domino effect,
yeah,
and then you say it will travel through the markets to markets outside of money and bonds, is that based on a similar understanding that the interdependence is dependent? Like the interdependence happens in a similar way, or is there a different mechanism behind it?
The interdependence happens because, you know, as I said, you've got some funds, you invest some money, right? If you see that the bonds are not giving you enough money, but the interest rate is going up, you're going to switch the money. Of course, you can switch the mutual funds in the States. You can buy, banks can borrow funds from building societies in the States, like it happened, you know, and get money and make you a mortgage available at very low interest rates. But once something goes wrong there, that's going to affect the loans from there, the interest rates from here, and it's going to go like this.
Good, thank you.
I was like, can you show the checking code for Instagram? Because I missed the checking code.
The checking
code, yeah.
The code?
Yeah.
What code?
It's on seat. It's on seat, the checking code.
Sorry.
The checking code, we need checking for this class.
I don't know. I mean, you have to talk. I don't even know what these are. Is this for attendance?
Yeah.
Yeah, you'll have to talk to the undergraduate. I have no idea. I didn't even know you had to do this.
So we don't have a code for this course.
A code?
Yeah, a code.
Are you enrolled in this course?
Yeah.
Oh, so it's on lawsuits.
Could it be that it's only for classes that you have to?
Yeah, we need to.
For everything? Oh.
Yeah.
Checking on you.
Yeah, the university saw this policy last semester.
Okay, talk to the I don't even know. Okay. Talk to the undergraduate office. Yeah.
Should go first.
I just wanted to ask, what's the average for this course?
You're not average. You're well above that.
I just want to know, like, around.
There's no average. I mean, in the past it has varied from 60 to 68. The average does well. And you're not average, so let's not talk about that.
Thank you.
Yeah.
I think your major research is on business cycle and monetary
Yes,
policy.
yes.
So I don't know what you, on so much extent that you agree on Ray Dalio's The Debt Cycle.
On
Ray Dalio.
who's that?
He's the founder of
Ray?
Bridgewater.
Oh, right.
I don't know to what extent is that you agree on its debt cycle.
But that's not business cycle, though, is it? Why do you think it's related to business cycles?
I think it's a major policy driven by the business cycle. Isn't it?
Really?
Yeah.
Say that again. So
It's majorly based on
send me.
monetary
Yeah. I mean, I'm not keeping up with everything. Oh, sorry. I'm not keeping up with everything. So what I would suggest you do is you send me a link, and we can have a chat about this if you want. So I know that we're both on the same page.
And about latest news about the China market, I mean, Mr. Miller was, or maybe the East Asia market like Japan. I think it's a major experimental field for current move in monetary policy.
Right now with Trump, I have no idea what to expect. I mean, I don't know whether these tariffs will like. I have no idea what tariffs are coming up, and how they will affect not just the Chinese but the Europeans as well. I have no idea, but it's a good sort of time to listen to actually look at
You know, like to share some of the briefs that China's government is considering a massive monetary policy to be working on after this, like the real estate crisis. And at the beginning of September, from the political bureau, suggesting that it is not that effective.
Let me just sit down a little bit because I've. Okay, sorry.
It is considered not that effective for a single monetary policy outbreak, because we witnessed that the BOC, Central Bank of China, has already operated a series of policies.
But I mean, I'm not. I mean, I've had some Chinese colleagues that work at the Central Bank of China, but I'm not. I'm never clear what they do, because their policy is very different to what we would do. I mean, the reason why I'm saying this is, I mean, we had discussions. Right. Right, okay, shall we carry on? Yep. And of course, if we finish earlier, then you can have more time to enjoy your evening. So, we've just said that money and bonds is really the two key assets that central banks use to influence the financial markets. So, another boring question, but I promise you we're going to move from next lecture much faster, is what are bonds? I mean, what are bonds? Bonds are it's basically a debt, right? It's a type of loan, as it says there, a debt security. But it can also be seen as an investment. So basically, people hold bonds for 2 or 3 reasons. You tell me, what reasons do they hold bonds for? If you're a firm, why are you holding bonds? Government bonds. Anyone? One, it's a safe investment, but I mean, we know that it's a safe investment, but there's a reason why they hold it. Obviously, to diversify their risky portfolio, to have some safe asset. But it's not just that. Firms must hold bonds because they can use it as collateral when they go to borrow. Yeah, I don't want to see risky assets as a collateral. You've got to have some safe assets. So even if I don't like bonds, I have to hold them. But then again, households will still want to hold some. They don't have a firm, but they think it's a safe asset, which will give you, it's a fixed income security, will give you some fixed interest rate. Fine, that's fine. So the thing is this now. Who are the bond sellers and the borrowers? There's always confusion. You know, you might find this a little bit funny now, but I can tell you now, and you will see many students still confusing who's the borrower and who's the lender. Right? So if I say to you, somebody sells bonds, is he the borrower or the seller? Sorry, is he the borrower or the lender? Yeah, that person is the borrower. So the one that sells bonds, I mean, think of it this way, that this is a piece of paper. I'll give you a piece of paper because I need money, basically. So I'll give you a piece of paper, and I'm asking you for money because I need to use it for something. Now, if I'm a company, I may want to use my corporate bond, okay, so I'll give you a corporate bond, to expand my business. If I'm a government, I may issue a bond because I want to finance my deficit or my debt, right? And if I'm a bank, a central bank, and I sell a bond to you, or I buy a bond from you, what do I do? I mean, let's say that I buy a bond from you. And you are commercial banks. Because the central bank, at least up to recently, only deals with the financial markets, not with the private agents. Right? So, if I am a central bank and I buy government bonds from commercial banks, what am I doing? Anyone? Am I increasing the money supply or decreasing it? I'm increasing it. Why? Because I buy pieces of paper from banks and I give them liquidity, money. So I increase the money supply. And this is the way banks operate. All this business, you know, first year macro, or and the bank increases the money supply. It doesn't work like that. Usually they do it through open market operations by buying or selling bonds. And that will affect the money. So the two are interdependent. So all governments, central banks, and the private sector can be borrowers. Sellers, or they can be lenders, which means the buyer. So the lender is the one who buys the bonds, the one who agrees to hold a piece of paper that says bond, I promise to pay back. This is the lender. I hold a piece of paper and I give you the money, so I'm the lender. Guys, do not confuse the two. Right? So, the demand for bonds is determined by the buyer, the lender. The supply of bonds, or the supply of bonds, provides the lender with a bond, a promise to pay a specified rate of interest during the lifetime of the bond and the repayment of face value. Right, okay. Next thing is, so are we all clear about this, yeah? How we do it? Okay, so if we are clear about this, then let's talk about different types of bonds. What types of bonds? I mean, it depends very much who issues them, right? There's government bonds. There's consols of perpetuity, not anymore really. There's municipal bonds, the corporate bonds, zero coupon bonds, convertible bonds, callable bonds, James bonds, and all sorts of other different bonds, you know. And these are the ones I'm covering now really, because these are the key ones. Just very briefly, when you say government bonds, and I'll tell you this is true even for financial markets, even for economists, when we say government bonds, we have something specific in mind, which is something that has been issued by the government or the central bank basically, but usually the government. So the thing is this now, government bonds are not exactly bonds. For example, if a government bond matures in less than a year, then we call it a bill. If it matures between 1 and 10 years, we call it a note. And if it's above 10 years, we call it a bond. But I can assure you that economists talk about the 5-year bond or the 10-year bond or the 3-year bond. We don't distinguish because they're all bonds, but the specific definition is this. Anything above 10 years is a government bond, and this is why the 10-year bond, which is the base of the actual government bonds, is what we call the benchmark bond. I'll come back to this. Then we used to have consols in this country. I mean, there was a British government bond, a gilt. It was originally issued in 1751, very interesting. And it was redeemable at government's discretion. So I mean, imagine this. You get this bond that says no maturity date on it. And the government can decide to go on forever. And really, it's the last 10, 15 years that the UK government's trying to pick up all these perpetuities and stop them. Because you can see that they go back to 1751. I mean, in 2014, there were approximately 2 to 3% of UK debt was held in perpetuity, in consols bonds. But I know that the government has probably eradicated most of them now. They got rid of them. So they're back to normal bonds. Then you've got municipal bonds. These are bonds issued by local governments and cities. Okay, what's the benefit then of having a... Why would you prefer to have a local government bond rather than a government bond? I mean, do you want it to be issued by Her Majesty's Treasury, or do you want it to be issued by the Manchester Council? I mean, that's the difference we're talking about. But the idea was this, that their return usually was tax-free. Why? Because when local authorities raised funds to fund some projects in a city, okay, they thought, I mean, they agreed with the government that it's fair, since this is for a local project, streets, traffic lights, in one particular city, since this is funded by the people, for the people of that locality, it shouldn't be taxed. It's not seen as an investment, it's seen more as an investment into the local community. And this is why their returns usually tax-free. Then you have corporate bonds, which of course belongs to something that we will not be talking too much about. The corporate bonds are bonds issued by corporations, firms. They involve a higher risk, so they must offer a high yield. You understand that? That if a firm is more risky than the government, they should offer a high yield to make their bonds attractive than the government. And usually when we take that difference between the corporate bond and the government benchmark bond, that's called the spread, okay? Or the premium, the risk premium in this particular case. The higher is the company's credit quality rating, the lower is the interest rates offered. True. And other variations are convertible and callable. I mean, sure, convertible is that you can switch your bond into shares or some other stock. Callable is when they usually have not just one maturity, okay, date, but there's a call date as well. In other words, they can call them in at an earlier date than the final maturity date. Sure. And then there's a zero coupon bond. This is where you get no interest at all. So you might say, why on earth would you hold such a bond? Right? Well, the zero coupon bonds are usually called also discount bonds. Why? Because instead of an interest payment, a coupon payment every month, what they say is that you buy the bond at 900, let's say, today, and upon maturity in 10 years, you will receive 1,000. So the face value is 1,000, but really you buy at a discount, and this is why they're called discount bonds. So you can think that the difference now between the 900 and the 600 that you paid with the 1,000 that you're going to receive at the end, all the compound interest payment is there upon maturity. So you don't have to deal with discounts. It's very much like, if you invest your money in a certificate of deposit or a fixed term savings, you will receive the money only after it matures in 2 or 3 years, whatever. That's the sort of idea here, that you get no zero coupon bonds, but you will get a discount, which of course it will be at the end. Fine. But of course I talked about some terms which probably some of you may not be familiar. I hope all of you are. But let me just go through them. The first thing I mentioned is maturity. Maturity is the lifetime of the bond. So it's the date on which the investor's principal, the face value or the capital that you invested, let's say £1,000 in a bond, expires, let's say, in 30 years, 20 years, whatever. And the lifetime of a bond or a bill or a note, it can vary a lot. It can vary from overnight or 1 day to perpetuities, as you saw, you know, it could be. But the typical bonds will be between 10 and 50 years. 10, 20, 30, up to 50. But up to 10 and 30, I would say, is the majority of them. Now, face value or par value is fixed final payment received on the day of the bond. Usually the face value is the same as the capital, right? For example, if you want to buy a £1,000 bond, that's the capital you put in, but that's also the face value because you will receive this at the end of the maturity, plus all the interest payments you will be receiving. Does that make sense? Yeah, you'll be receiving the fixed income interest payments, but you will also receive your money back, which is the face value. Then you have the coupon rate, which I'm going to denote as IC, and the coupon payment as capital C. Now, the coupon is the amount the bondholder receives as an interest payment. Please do not confuse the interest rates here, and I'm not blaming you. When we talk about interest rates in this course, in the financial markets, there's 1,000 interest rates. The good thing with interest rates is usually they move in the same direction. So you're pretty safe to say it's going to go up or down because, you know, there's like a domino effect. But do not be confused with the interest yield and the coupon rate. So, if, for example, a bond pays a 10% in coupon payment, in interest rates, and its face value is 1,000, it will pay £100 in coupon payments until it matures. Now, do you know why it was called coupon? Because back in the old days, I mean, now you can sit here and buy government bonds just as you wish on your app, right? But back then, oh God, I mean, back then, you had to go to the bank, queue, and you'd buy a government bond or from a government office, and then you'd be given a big piece of paper with little coupons that you would tear off. You know, every year you would take one of them, you'll tear it off, and go to the post office or the government sort of agency and say, "Where's my coupon payment?" But now that is done automatically, you know. So, but we still call them coupon payments. Now, guys, this is something very important, the yield to maturity. Do not confuse this interest rate with the interest payments that a bond makes. The yield to maturity is the interest rate that equates the total present value. Now, you might find this a little bit of a difficult thing to comprehend, but I'll come back to this. But it is the interest rate that equates the total present value of all cash flow payments received from a bond with its current market value price. So, the yield to maturity takes into account, when you're trying to work out the yield to maturity, you take into account basically everything. The coupon payments, the maturity, but also when you work out the yield to maturity, you're supposed to be taking into account that every year you reinvest back into that bond until maturity. Does that make sense? Otherwise, you will never be able to accurately pin down the yield to maturity. That's why it's called the yield to maturity. Therefore, if you take the money before it matures, because you sold the bond, that's not yield to maturity you'll be receiving. The idea is that you reinvest all the money back into that bond. So, it's worked out for one point in time, treating everything as given in that time. The yield to maturity, I know you're thinking, of those who are not familiar with it, of course that sounds really hard, right? And it is hard. And this is why you don't work it out by hand. The yield to maturity, you need a calculator, which is a specific yield calculator. On the internet, there are thousands of yield calculators, but it will ask you for some things. Maturity, interest market rate, price of the bond, or the interest payments, the coupon payments, to be able to find out what the yield to maturity is. So, to understand how we work out the yield to maturity, let's go back to something which probably you all know. I mean, you're economists at the third-year level here. And I've not taught second or first year for many years. I don't know. You know, I've only taught the third year and the postgraduate students. So I can't remember exactly what you do, but at some point you've came across this term, the present value, right? You must have. So let me just remind you what the present value is, and then we can take it from there. Probably one of the most useful concepts to financial economists and economists in general. The face value is, if I take the cash flow in n years and I discount it by the market rate today, that will give me the present value of this particular value in the future. Perhaps a good example will be this, which I usually give because students understand this much better. Let's say that in a year from now, you're about to graduate. Well, I hope before that, but you know what I mean. Let's say in a year from now, you graduate and your parents are so proud of you that your dad or your mum says, I'll give you £1,000 in a year from now when you graduate. I know nowadays you will get a little bit more than that from your parents, but anyway, let's stick to £1,000. £1,000. Now, you as a little nerdy economist will say to your dad or your mum, you're not giving me £1,000, Dad. You're giving me, let me work it out, you're giving me £961. Why? Because you're offering me this money not today, but in a year from now, and the market rate is 4%. Therefore, in a year from now, with a market rate of 4%, the actual value you give me is 961. Why? Because you think like an economist. You think that, you know, if I had this money and invested it, I would have another £40 there, you know. So basically, that's the idea. The present value refers to exactly that, that you work out the present value of a sum in some future date by discounting it at today's, that's why it's called present value, at today's discount rate, usually the market rate of that particular asset. Right? Are we clear about this? Good. Of course, if that was in 2 years from now, if you work it out, that would be 924. Therefore, £1,000 today is not actually £1,000 in a year from now, if the market rate is 4%. That's the idea here. And that is the basic concept of the face value. Why am I saying this? Because now when you look at a bond has a maturity, you can trade it, unlike the money that you were promised by your dad. You know, you can do things with this. You can trade it and get some return, but you can actually hold it until maturity or not. So if you want to work out the present value of an annual cash flow, for bonds in other words, then what do? Is you've got to take the cash flow, and what is the cash flow? The cash flow is the coupon payments that you'll be receiving every year, right? That's the cash flow. So you'll be given. So you'll be given this, and you'll be given this all the way to n, whatever n is maturity, n is periods. Therefore, if the cash flow is 100, every year you receive £100, £100, £100. And I, the market rate is 5%, at which you discount this. Then if you do this, you can write it, of course, like this. You will find out that in 3 periods, if n is 3, it will be 272. And of course, this is the present value. I mean, I can summarize this to n period, or I can put it to 3. Yeah, I don't want to be repeating myself. I mean, we've done maths, you know, to make our life a little bit easier. I can write this as this, with the sum, the summation term. Now, let me just tell you how you work out the price of a bond. Because sometimes present value is one thing, but is price of a bond a different thing? I will say yes, but not always. So, if you want to work out the price of a bond, then what you do is you take exactly what you do here, which is the present value of annual cash flows, and you add the face value. Why? Because with bonds, you will also receive your initial capital back, right? You will receive the money back. So you will have the present value of annual cash flows, and then you will also have the face value discounted in n periods. So if you do this, let's say an example, you've got a face value of £1,000, so you invest £1,000 in bonds. You've got a market rate of 5%, which you're going to use as your discount. That works out cash flow, sometimes it's C, sometimes it's CF, doesn't matter, of £50. And let's work it out for 3 periods. You will find that the first term here is 136.16, roughly. And if you work out the second term, which is the face value, divided by the 1 plus 0.05 to the power of 3, it will give you 864, right? If you add these up, what does it give you? It gives you the price that you paid. See, this is magic now, and I'll tell you why. Because this is the idea of the present value of a bond. The idea is this, that when you first issue a bond, and you're thinking, what price should I charge for this bond? It should be the face value, right? In other words, you discount with the risk and the interest payment, the interest rate of today, and you say to them, well, this is what you should do. Because you see, when I give you money, when I give you the money back, the price that you will pay today is the face value, right? Because I've worked it out that you will get this money back, right? So, be clear, this is not all the money that you're going to get back, right? You will be receiving cash flows. All I'm saying is that the face value will coincide with the price when you first issue a bond. Try any example you want. It will always work out this way, that it will come to face value being the price. So, the price of a bond, this is something that we'll use throughout the course. Looking at this now, okay, here's a question. This is a very, very interesting question. Looking at this, where's the yield? Can somebody tell me? I mean, I've got everything, all the information I need. How do I work out the yield? Obviously, you can go into a calculator, use all these values here. The 1,000 face value of the price that you paid, the interest payment, or the coupon payment, you've got the maturity. But of course, if you've got this and this, you don't need this. That's clear, right? So if you have this, this, and this, you can work out the price. Or if you've got the coupon payments and the interest rates and the maturity, you can work out the face value. So where's the yield? Anyone? Okay, and I'll tell you why now it's so difficult to work out the yield. See this equation here? This here is gross payments, in other words, 1 plus I, interest, to the power of something, where t can go from 1 to n, which means if I want to work out the yield, I've got to go to a calculator and work out, take this equation here and solve for this I here. Are you with me? That I, once I solve from that equation, it will no longer be 5%. You understand that? Only when I solve for that I, and as I said, it's very difficult because there's powers involved, and this is why we use calculators. But once I solve for this I here, you will find that the price will come in the denominator. But that I, that unique I, there will be only one I, right? Because there's discounts here, different powers. You understand that? But once, I repeat, I solve for that unique I, that will be the yield to maturity. It's not easy to do by hand for the reasons I explained. So, but remember this, and now you can go back to the yield to maturity, and that will make sense now. I think that will make much more sense now. Remember what I just told you, that you take the present value equation, which is the same as the price when you first issue the bond, and what do? You work out from there the yield to maturity. So what is the yield to maturity? Is the interest rate that equates the total present value of all cash flow payments received from a bond with its current market value. So you take the price, okay? Are you with me? Following? You take the price as given and you solve for the interest rate, and that interest rate will equate the face value, which is the present value. All this is the present value, of course, yeah? You will equate the present value, which is of all annual cash flows, and the present value of all face, by solving for the interest rate. So that's good. Are we clear about this? Because I've realized that even you people who've done corporate finance, you're not very clear of what the yield to maturity is. And to our course is fundamental. So the price of a bond now is inversely related to interest rates. I hope you understand this, because everything we'll be doing comes from this, from the present value of a bond. So once you do this, if you solve for the yield to maturity, you understand that the price will come as a denominator. But even as you see it here, you can see that when this goes up, the I, the price will go down. And throughout this course, we'll say that the price of a bond is inversely related to its interest rate, or the yield. A rise in one implies a fall in the other. Okay, and we've just checked this with the formula. Now, this is the other thing that we said, that when you first issue a bond, the face value will be equal to the price. We've seen that with an example, right? But from then on, guys, this is not. It will be only by chance that the price of a bond will be equal to the face value. This is when you first issue it, theoretically, what you should be doing. And why will it not be the same anymore? Because the face value has been promised, correct? I mean, you paid £1,000, you will receive back £1,000. That cannot change. But throughout the 50 years that you hold the bond, many things will be changing. And the demand and supply for bonds will be changing. Therefore, the interest and their price will be changing. Therefore, the actual price staying the same as the face value after that date is only by chance. So what will determine from then on the price and therefore the interest rates of a bond, it's down to good old demand and supply, right? So we economists would like to think that we like to see price on this side and quantity on this side. So I'll stick to it for now. You can see the demand for bonds is downward sloping. Why? Because if the price of a bond drops, can you see that? I can demand more of that bond, just like a normal good. But you can see that the interest rate here is moving in the opposite direction to the price of bonds. Please pay particular attention. The arrows here, can you see them? In other words, when the price goes up, the interest rate goes down. Right? So here, for example, the interest rate is low. Whereas at a very low price, the interest rate here is high. So the interest rate is rising this way and the price is rising this way because they're inversely related. And as I said, remember who the demand for bonds is the buyer. Okay, they demand bonds, but they're the lenders. Therefore, if you're a lender, what would you like to see, a high interest rate or a low interest rate? A higher. Let's see, is that the case? I mean, here it says that, demand for bonds increases. Can you see here? The higher is the interest rate. But of course, that implies a lower price. So you want to see a lower price, but a high interest rate. Of course, the supply of bonds now is the one who issues the bond and the one who's the borrower. These guys need the funds. I mean, it could be the government, it could be a corporation, it could be anyone, but they issue the bonds because they need. My God, it's like being in a plane in here. So I travel a lot, and that's what gives me that impression. So basically, this is what that does. The supply of bonds is upward sloping, right? And you can see the opposite here. The one who issues the bonds, the borrower, wants to see what? He'll be paying the interest payments. They want to see a low interest rate. I mean, the lower the interest rate, the happier they will be to issue bonds, right? And they want a higher price, correct? Why? Because the price is the funds that they will get. And that's exactly what that says. The supply of bonds is upward sloping because the higher is the price, the more happy they are to provide more. And of course, the higher is the price, the lower is the interest rate. The interaction of the two, demand, supply of bonds, bondholders, bond issuers, and demand for bonds will come together. And at this point here, we'll have equilibrium. Okay? And that will determine the price and the interest rate. And I repeat, once you issue the bond, which, as we said in economics and in finance, theoretically we say you issue the face value equal to the price. From then on, that's not the case. The face value will stay fixed throughout the maturity of the bond, but the price will be changing depending on what's happening in financial markets, demand, supply, and all that. Changes in prices or interest rates, of course, will be movements along, but then there will be things that will be shifting the demand for bonds. And here are the factors that shift the demand for bonds. Okay? Any of these, I've put them in a table here, will shift the demand for bonds. So let's have a look. Wealth. Higher wealth and in economic booms, for example, increased bond demand. Does that make sense? Yeah, I mean, I'm wealthier. I've got more money for everything, really. Therefore, I can afford to demand more bonds. Fine, okay. But also during economic booms. Why? Because whether it's corporations that they need to issue more bonds, they will increase the supply of bonds, but of course I'll be happier because I'm wealthier and everything's going fine to increase my demand for bonds. The other one is the expected return. Now, this is an interesting aspect of bonds because we did say that we look at the face value all the way to maturity, theoretically, conceptually. We're economists, we're university, we think like that. But in reality, many people, I repeat, will buy bonds to trade them, to make profit before maturity, right? And this is what these people will be looking at, the return. Why? Well, let's have a look. What's the difference between the yield to maturity and the expected return? The yield to maturity, as we said, is that interest rate that equates the present value of the price all the way to the end of the maturity. The expected return now is what you expect to gain or lose from changes in prices. You know, high demand, lower demand. The demand for bonds will fluctuate. Therefore, the return is something like this. Let's say that I hold the government bond just for one period. I bought it today. Why? Because I expect the return to be high. Why? Because I expect the price to go up. And then I'm going to sell it in one period. So this is exactly what that says. That if this, this is the current yield, the cash flow divided by the price, it will give me the current yield. There's no face values in that. I'm only holding it for one period, right? This is not the whole story. So there's the cash flow divided by the price. That will be the current yield. But this here is the rate of capital gain. You see, if I expect the price to be up, in other words, if I expect this term, the second term, to be positive, I expect the price of bonds to go up. And that will give me a high expected return. And this is where the demand for bonds increases. Clear? This here? Yes. Well, I'm saying that if you hold it for one period, this is not the cash flow, this is not the present value we're looking at. This is only, if I hold it for one period, where do I make my money from? And the answer is, I will have a cash flow for that 1 year that you will receive it, divided by the price in real terms. But again, when you sell it, the price will have changed in one period later. If the price is positive here, in other words, if this term, the PT plus 1, next period, is higher than now, I will make a gain from here. This is the rate of capital gain. Yep. Right. Jesus. What else? News coming in. Right. Expected interest rate now. From the present value, an expected rise in the interest rate reduces the expected price. Do you remember that? What we said, that the interest rates move in the opposite direction to prices. Therefore, if I expect the interest rates to go up, what do I expect the price to do? To go down. Therefore, expected interest rates will mean that my demand for bonds drops. Expected inflation, that's very interesting. Inflation raises the price of a physical good. And that was the contribution by Friedman, which was immense. In a way, what he was saying is that, you shouldn't be looking just at 3 different assets, bond, money, and something else. You should also be looking at physical goods. Because if I know that the price of cars will go up next year because we're out of Europe or whatever, you're in the States and tariffs go up, and you've always wanted a Toyota, what are you going to do if it's not built in the US? You're going to buy the goods then before the price doubles or goes 50% or 30% up. And this is the idea here, that you've got to look at expected inflation, because expected inflation will mean that people will be buying goods, moving away from bonds. They will want to buy a house before the price goes up. They want to buy a car or a fridge before the price goes up, if they know the price is going up. So expected inflation is exactly like that. But high expected inflation also raises the expected interest rates, correct? They go hand in hand, So if you expect inflation to go up, you expect interest rates to go up, which means the price of bonds will be going down. Therefore, the return on bonds will be going down. Therefore, again, that's another reason why the demand for bonds. In fact, expected inflation kills assets, basically. High risk. A high risk results in a high interest rate yield, and thus a lower price. We all understand this. You know, high risk means a higher interest payment, which means you will need a high yield. If you don't get that, then the demand for bonds for the same yield will go down. High liquidity increases the demand for bonds. Other things being equal, the longer is the maturity of a bond, the lower will be the present value. Fine, that makes sense. And there's the picture here of the present value. Basically, the more liquid is something, you need a lower interest payment. As you commit your money for a longer period and it becomes less liquid, then obviously you want to see a higher yield. And this is why the present value will drop and the price as the maturity goes up. Business cycle expansion, that's all very well explained, is becoming wealthier and all that. And then I've got here factors, I mean, time's running out now, if this is correct, So just very briefly, go through this. This is the supply of bonds. What is affected? High profitability. If businesses feel that this is the time to invest in projects, the supply of bonds will move to the right. High expected inflation has two effects here. Because remember, we've just said that high expected inflation will reduce the demand for bonds, right? But it will increase the supply of bonds. Why? Not quite. It's because, you know, the supply of bonds is the people who want the funds. So, if for some reason you expect inflation to go up, which means interest rates to be going up, but you have committed to an interest payment in a bond, these guys will be borrowing much cheaper. And that's why they're happy to provide more. High government deficits imply fiscal authority will increase the supply of bonds. We understand that. And that will shift the supply of bonds to the right. Business cycle expansion. Well, this is the case where both the demand and the supply of bonds will move to the right. Businesses will be expanding, people will be wealthier, everything moves to the right, and therefore there will be a higher quantity of bonds. And finally, higher corporate taxes. I mean, that's the American idea that if you tax corporations, they may not want to supply bonds to expand their businesses, therefore that will reduce the supply of bonds. There's a particular case which is interesting, which will cover in the class, which is the case of Japan, where prolonged recession and negative inflation caused interest rates to be negative. And here, guys, this is what I'll say, and we're finished. I will always do what we do in practice. In this first lecture, there's not much to talk about because with definitions and all that. But have a look here. I mean, this is a conventional table that you will pick up from Financial Times, let's say. Here you've got, you see the little N here? I mean, remember, this was taken in the newspapers in 2006. And here's maturity, it says 0.8. Therefore, this is a note, right? It's not exactly a bond. It's only 2 years. And this is why it has that little N there. Then it gives you the bid price, which is what it actually sold for. This was what they wanted. This is what they sell for. And this is the change from the previous ask, or the price. Sometimes it gives you the change in bids or change in price. Same for the bills. And here, I've given you the explanations when you look at these tables, how to understand this, which is what I've just said. And the final picture here is, again, from the Wall Street Journal, which basically shows you something that we said. Basically, look at the yield. I mean, these are bonds because I've taken that in 2014, and these go, okay, well, these are not, that's why, but 16, 17, okay. But after these ones here are government bonds, okay, these are notes. And you can see this, that as maturity increases, as we move down, in other words, and maturity increases, look at the yield to account for risk. Usually you would expect that the yield curves are upward sloping, and we'll do that in the next lecture. In other words, you will expect a high yield for a high maturity, right? Fine. Guys, we'll leave it there. Thank you for coming. I'll see you next week. And do sign up on Piazza.
Are we doing the check-in for the seats code?
Further? I've no idea. Somebody else asked me. I have no idea how you do this, but ask the undergraduate office. I didn't know you had to do this.
Okay, okay.
Hi.
Wondering what the sort of